Hi, I'm Jennifer Timm, a real estate wealth advisor licensed in both California and Oregon. I specialize in 1031 exchange strategies and generational wealth building through real estate. Whether you're in Portland, Dunthorpe, Beaverton, Lake Oswego, or West Lynn, Oregon, along the stunning Southern California coastline in San Clemente, Dana Point, San Juan Capistrano, Laguna Beach, or Newport Beach, or anywhere across the country. Today, I'm revealing a powerful tax deferral strategy that could save you hundreds of thousands of dollars in capital gains taxes while eliminating landlord responsibilities. Have you ever felt trapped by your investment properties? You love the passive income and wealth building, but you're exhausted from tenant calls at 2 a.m. about broken water heaters? Or maybe you're sitting on a highly appreciated rental property and the thought of paying 40 to 55% in combined federal capital gains taxes, state taxes, and that 3.8% Medicare surtax keeps you up at night. Today, we're diving deep into Delaware Statutory Trusts, DSTs, and how they work within a 1031 exchange to defer capital gains taxes. By the end of this video, you'll understand exactly what a DST is, how to use DSTs as 1031 exchange replacement property, the pros and cons, and how non-recourse debt in DSTs solves your debt replacement challenge. Let me tell you about Susan, not her real name, but her story is absolutely real. Susan owned an 8-unit apartment building in southeast Portland that she purchased 20 years ago for $400,000. Fast forward to 2025 and that investment property is worth $1.8 million. Sounds like the American dream, right? But here's the reality. Susan was managing 8 rental units, dealing with tenant turnover, coordinating repairs with contractors, and honestly, she was completely exhausted. She wanted to retire, travel with her husband, and spend quality time with her grandchildren. But when her CPA showed her the projected tax bill from a straight sale, over $550,000 in combined federal and state capital gains taxes plus depreciation recapture, she felt completely stuck. Sound familiar? This is the exact situation where most real estate investors find themselves at some point in their wealth building journey. You've built incredible equity, but you're facing 3 major challenges. First, the capital gains tax burden is crushing. Between federal capital gains tax rates up to 20%, state income taxes, which in Oregon can be 9.9%, California up to 13.3%, depreciation recapture at 25%, and the 3.8% net investment income tax, Medicare surtax, you could lose 40 to 55% of your equity to taxes. Second, you're tired of active property management, whether it's dealing with difficult tenants, coordinating maintenance and repairs, managing vacancies, or the stress of being a landlord in the Portland Metro or Orange County areas. You want passive real estate income without the headaches. Third, time is not on your side with traditional 1031 exchanges. If you do a standard like-kind exchange, you have just 45 days to identify replacement properties and 180 days to close. In competitive West Coast markets like we are in, finding the right investment property in that window can feel impossible. Disclaimer: the material is provided for general informational purposes only and should not be construed as investment, tax, or legal advice. The information contained herein has been obtained from sources deemed reliable and is provided without any warranty or guarantee of its accuracy, completeness, or results from using the information. Past performance of any market results is no assurance of future performance. You should consult your own legal, financial, or tax advisor and verify all information to your satisfaction prior to taking any action. This is exactly where Delaware Statutory Trusts become a game-changing 1031 exchange strategy. What is a DST? So what exactly is a Delaware Statutory Trust in a 1031 exchange? Think of it as a legal investment vehicle, a trust created under Delaware statutory law that holds title to institutional grade commercial real estate and qualifies as like-kind replacement property for Internal Revenue Code Section 1031 exchanges. Here's how DST real estate investments work in plain English. A professional real estate sponsor company. We're talking about established DST sponsors with decades of experience, like K Properties, Inland Private Capital, or Pasco Companies, acquires a high-quality property. This might be a Class A multifamily apartment building, a portfolio of medical office buildings, an Amazon distribution center, or a collection of Walgreens and CVS pharmacy locations on long-term triple net leases. The DST sponsor then structures this property within a Delaware Statutory Trust and sells fractional ownership interests to accredited investors like you. You're buying a beneficial interest in the trust, which owns the investment-grade real estate property. Now here's the critical IRS ruling. Back in 2004, the Internal Revenue Service issued Revenue Ruling 2004-86, which officially blessed DSTs as qualifying replacement property for 1031 exchanges. This means that for tax deferral purposes, your beneficial interest in a DST is treated as direct real estate ownership. It's considered like-kind property under Internal Revenue Code Section 1031. You get all the tax benefits of owning real estate without any of the property management responsibilities. Let me paint you a picture. Imagine owning a fractional interest in a $75 million luxury apartment complex in Irvine, California, or a medical office building portfolio in Beaverton, Oregon, professionally managed by a team with hundreds of employees, institutional property management systems, and decades of commercial real estate expertise. Your minimum DST investment might be $100,000 to $250,000, and you're alongside other accredited investors who collectively own these trophy assets. You receive your pro rata share of the monthly rental income, typically on a monthly basis via direct deposit into your bank account. No phone calls about leaky faucets at your San Juan Capistrano rental. No screening tenants for your Portland duplex. No coordinating HVAC repairs. It's truly passive real estate ownership with potential tax advantages. DSTs in 1031 exchanges. Now let's talk about how Delaware Statutory Trusts fit in a 1031 exchange strategy, because this is where they become incredibly powerful for tax-deferred wealth building. You all know the basics of a like-kind exchange under IRC Section 1031, right? It's been part of our tax code since 1921. Sell an investment property, reinvest all the proceeds into a qualified replacement property of equal or greater value, and defer your capital gains taxes and depreciation recapture. But the IRS 1031 exchange rules are strict. You must identify potential replacement properties within 45 days of closing on your relinquished property, and you must close on your replacement property within 180 days. You also need to work with a qualified intermediary to hold your proceeds. Here's where DSTs offer remarkable 1031 exchange advantages over traditional replacement property. Advantage number 1, speed, certainty, and compliance. DST properties are pre-packaged, pre-vetted 1031 exchange replacement investments. The properties are already acquired by the DST sponsor. The institutional due diligence is complete. The non-recourse financing is locked in with the lender, and you're ready to close. You can close on a DST investment in as little as 3 to 5 business days. Compare that to trying to find, negotiate, inspect, obtain financing, and close on a traditional property in competitive real estate markets like Tigard, Oregon, Costa Mesa, Huntington Beach, California, within your 180-day exchange window. Remember Susan from Southeast Portland? She identified 3 DST properties within her 45-day identification period, a multifamily apartment portfolio in Dallas, Texas, a medical office building portfolio in Phoenix, Arizona, and an industrial warehouse property leased to FedEx. All were institutional quality assets she could never have purchased on her own as direct real estate. She closed on all 3 DSTs within 10 days of selling her apartment building and met all IRS 1031 exchange requirements. Advantage number 2, diversification across markets and property types. Instead of putting all your equity into one single-family rental or one apartment building in one Portland neighborhood, you can spread your 1031 exchange investment across multiple DST properties in different asset classes: multifamily, medical, industrial, retail, triple net lease, and different geographic markets. Susan went from 8 units in one Southeast Portland location to fractional ownership in over 500 apartment units across 3 states, significantly reducing her concentration risk. Advantage 3, the exact dollar match for tax deferral. Ever tried to find a replacement property at exactly the right purchase price? If you're selling for $1.2 million, finding something for exactly $1.2 million or more to fully defer capital gains is challenging. With DST fractional ownership investments, because you can invest in multiple trusts and because they allow investments starting at $250,000 to $100,000 minimums, you can match your 1031 exchange reinvestment amount down to the penny. If you sell a rental property for $1.3 million and find a commercial building you love for $1.1 million, you can fill that $200,000 gap with a DST investment, ensuring you defer 100% of your capital gains tax and avoid any taxable boot. The debt replacement solution. Now here's where DSTs with non-recourse debt become absolutely brilliant for 1031 exchange investors, solving the debt replacement requirement. Let me explain the 1031 exchange debt problem first. To fully defer your capital gains taxes in a like-kind exchange, IRS rules require you to replace 2 components, your equity and your debt. So it's not just the equity. You do have to replace that mortgage debt too. If you fail to replace your debt, you'll trigger what's called mortgage boot, which is taxable. Let's walk through a real example. You sell an investment property for $1 million with a $400,000 mortgage. After paying off that loan at closing, you net $600,000 in equity held by your qualified intermediary. Most real estate investors think, great, I'll just reinvest my $600,000 cash proceeds. But there's a problem and will result in unexpected taxes. To fully defer capital gains taxes, you must purchase replacement property worth at least $1 million, and you need to replace that $400,000 in debt. Your traditional options were limited. Number 1, take out a new $400,000 loan yourself. Requires loan qualification, personal guarantees, credit checks. Number 2, add $400,000 cash from your own pocket to make up the difference, or accept partial tax deferral and pay capital gains taxes on the $400,000 mortgage boot. For many of my clients, especially baby boomers in retirement, those downsizing, or investors who don't want personal loan recourse, none of these debt replacement options are attractive. They don't want to qualify for a new commercial loan. They don't have extra cash reserves sitting around, and they certainly don't want to pay unnecessary capital gains taxes. Enter the DST with built-in non-recourse debt, the 1031 exchange debt solution. Most Delaware Statutory Trusts come prepackaged with institutional financing already secured at the trust level. These loans are obtained by professional DST sponsors from major commercial lenders, typically with loan-to-value ratios ranging from 25% to 70%. Here's what makes this extraordinary for 1031 exchanges. First, you don't personally have to qualify for the DST loan. The lender doesn't pull your credit, doesn't verify your income, doesn't require personal financial statements or tax returns. The Delaware Statutory Trust itself is the borrower, not you as an individual investor. Second, the debt is non-recourse financing. This means if something catastrophic happens, which is extremely rare with institutional quality properties managed by professional teams, the lender's only recourse is the property itself. The lender cannot come after your personal assets, your home and Lake Oswego, your retirement accounts, or other investment properties. Your liability is limited to your invested equity in the DST. Third, the non-recourse debt is automatically proportioned based on your investment. If you invest $100,000 in a DST with 50% leverage, you're automatically assigned $50,000 in equity and $50,000 in proportionate debt, giving you $100,000 in total replacement property value for 1031 exchange purposes. Let me give you a client example. Michael, one of our wealth building clients in Dana Point, sold his medical office building for $2 million. He had a $1.2 million commercial loan on the property, netting $800,000 in equity. Michael is 67 years old and has absolutely no interest in going through commercial loan underwriting for another $1.2 million loan. We structured his 1031 exchange by placing his $800,000 equity into two Delaware Statutory Trusts, one multifamily DST with 60% LTV and one industrial with 50%, strategically structured to give him exactly $1.2 million in non-recourse debt replacement. He replaced every dollar of equity and every dollar of debt, deferred 100% of his capital gains taxes and depreciation recapture, and now receives monthly passive income distributions without any property management duties, personal loan liability, or loan payments coming from his bank account. Pros and cons of DSTs. Now, I always believe in complete transparency with my real estate investment clients. So let's talk about both the advantages and the limitations of DST investments in 1031 exchanges. First, the pros of Delaware Statutory Trusts. Complete passivity. Zero landlord duties, no tenant management, no maintenance coordination, no 2 a.m. emergency calls. Professional institutional property management handles everything. Tax deferral through 1031 exchanges. Defer federal capital gains taxes up to 20%, state income taxes, depreciation recapture, that's that 25%, and the 3.8% net investment income tax, Medicare surtax, through IRC Section 1031 like-kind exchanges. Institutional quality real estate, access to trophy assets you couldn't purchase individually as direct real estate. Think $50 to $150 million properties with Fortune 500 tenants, Amazon distribution centers, Class A multifamily apartments, and business office portfolios. Portfolio diversification, spread 1031 exchange investments across multiple DST properties, different asset classes, multifamily, medical, industrial, retail, multi-net lease, and diverse geographical markets to reduce concentration risks. Non-recourse debt solution, built-in institutional financing with no personal liability, no loan qualification required, no personal guarantees, and automatic debt replacement for 1031 exchanges. Estate planning benefits. Simplified fractional ownership structure makes it easier to transfer generational wealth to heirs, much simpler than dividing whole properties amongst multiple children. 1031 exchange continuation. When your DST sponsor sells the property, typically 5 to 10 years, you can execute another 1031 exchange into new DSTs or traditional real estate, continuing tax deferral indefinitely. Accredited investor access. Minimum investments, typically $25,000 to $100,000, make institutional commercial real estate accessible to qualified investors. Here are some of the cons you need to know. Illiquidity. DSTs are designed for hold periods of 5 to 10 years typically. There's no secondary market or easy exit strategy before the DST sponsor decides to sell the property. Loss of control. You cannot make management decisions, choose tenants, approve capital improvements, or influence property operations. The DST sponsor/trustee controls all operational decisions per IRS Revenue Ruling 2004-86 requirements. Accredited investor requirement generally requires 1 million net worth, excluding primary residence, or 200,000 plus annual income per SEC regulations. Minimum investment thresholds, usually $100,000 minimum investment, though some DST sponsors offer $25,000 minimums for certain offerings. Fees and costs. Acquisition fees, typically 1 to 3%, ongoing asset management fees, property management fees, and potential disposition fees are built into the DST investment structure. Real estate market risk. These are actual commercial properties subject to market conditions, economic cycles, tenant vacancies, lease expirations, and property-specific risks. No depreciation control. You cannot accelerate depreciation through cost segregation studies since you don't control the DST property. IRS rule changes risk. While DSTs have been blessed by the IRS through Revenue Ruling 2004-86 since 2004 and are well established, theoretically IRS rules could change, though this is considered unlikely given 20 plus years of precedent. The bottom line, Delaware Statutory Trusts are powerful 1031 exchange tools, but they're not suitable for every real estate investor. They're ideal for accredited investors who want passive income, tax deferral, estate planning simplification, and who can commit to longer hold periods without liquidity needs. Who should consider DSTs? So who are the ideal candidates for DST 1031 exchange investments? Number 1, the exhausted landlord. You've built substantial equity through rental property ownership, but you're done with active property management. You want passive real estate income for retirement without tenant calls, repairs, or vacancies. Number 2, the portfolio diversifier. You own 1 or 2 concentrated properties in the Portland metro area or Orange County and want to spread your 1031 exchange into multiple assets across different markets and property types to reduce risk. The estate planner. You're simplifying your real estate portfolio for easier generational wealth transfer to your children. DST beneficial interests are much easier to divide amongst heirs than trying to split a duplex in Beaverton or a retail building in San Clemente. 4. The 1031 deadline warrior. You're in the middle of a like-kind exchange and running out of time in your 45-day identification period, or you can't find suitable replacement properties in competitive West Coast markets. 5. The debt replacement seeker. You have significant mortgage debt to replace in your 1031 exchange and don't want to qualify for new commercial loans, provide personal guarantees, or go through bank underwriting. Number 6, the out-of-state investor. You own rental properties but have moved away from Portland, Newport Beach, or wherever your rentals are located, and remote property management has become too challenging. I work with all of these investor profiles regularly in the Portland metro area, including Portland, Lake Oswego, Westland, Tigard, Beaverton, and throughout Southern California's coastal communities such as San Clemente, Dana Point, San Juan Capistrano, Laguna Beach, Newport Beach, Huntington Beach, and Costa Mesa. Recently, we helped a couple in Laguna Beach who owned 3 older rental properties and wanted to simplify their investment real estate for retirement. We consolidated everything into 4 DST investments across different property types: multifamily apartments, medical offices, industrial warehouses, and retail triple net leases. They increased their passive cash flow by 40%, eliminated all active property management duties, and deferred over $800,000 in combined federal and state capital gains taxes. Final thoughts. Here's what I want you to remember. Delaware Statutory Trusts are not exotic or risky investments when properly structured. They're IRS approved via Revenue Ruling 2004-86, time-tested 1031 exchange replacement property vehicles that have helped thousands of accredited real estate investors preserve wealth, defer capital gains taxes, and create passive income streams that can last for generations. So whether you're sitting on an appreciated apartment building in Southwest Portland, managing rental properties along the Oregon coast, or own commercial space in coastal Orange County, San Clemente, Dana Point, Laguna Beach, or even Newport Beach, DSTs might be that missing piece in your tax-deferred wealth building strategy. The key is working with an experienced real estate wealth advisor who has understanding about DST investments and have access to vetted DST sponsors and quality offerings, and who can structure 1031 exchanges properly within your overall financial and estate plan. If you're interested in learning more about how Delaware Statutory Trust could fit into your 1031 exchange situation, I'd love to have an educational conversation with you. No pressure, no sales pitch, just education and strategy. You can reach me at jennifer@welcomehomeglobal.com or click the link in the description to schedule a complimentary 1031 exchange consultation. Remember, the goal isn't just to build wealth through real estate, it's to build wealth that lasts for generations, protects your family from unnecessary taxes, and gives you the freedom to live life on your terms without landlord headaches. Final disclaimer: the material is provided for general information purposes only and should not be construed as investment, tax, or legal advice. The information contained herein has been obtained from sources deemed credible and is provided without any warranty or guarantee of its accuracy, completeness, or results from using the information. Past performance of any market result is no assurance of future performance, and you should always consult your own legal, financial, or tax advisor and verify all information to your satisfaction prior to taking any action. Thanks for watching, and I'll see you in the next video where we'll dive into more wealth building strategies, because we believe that your legacy begins with a real estate plan. Don't forget to subscribe and hit that notification bell for more tax-saving real estate wealth strategies.